Hello viewers, welcome to today's video. In this video, I'm going to talk about a critical metric that many investors use before pressing the buy or sell button on a stock. There have been instances when even I have liked a business model and management a lot and yet have not gone ahead with the recommendation as the stock failed to meet this critical criteria for me. In fact, some of my favorite businesses failed to give me a comfort on this front. The metric that I'm referring to is PE ratio or price to earnings ratio. In simple terms, it suggests how much market is willing to pay for a unit of earnings. For instance, if a stock is trading at rupees 100 and has made rupees 10 in net profit per share, its P ratio is 10. It means that Mr. Market is willing to pay rupees 10 for every rupee of net earnings per share. A high PE stock is perceived to be expensive, while the one with low PE is often considered to be cheap. Later on, I'll talk about how to make sense of PE ratio. But before we move on to the stock specific PEs, please note that the PE ratio could also be applied to market indices such as Sensex, where one can compare long term PE with the current PE to get a sense whether the markets are overheated or bearish. The ratio could be trailing or forward looking. Let's understand the trailing PE concept. I'll come to the forward PE later. It shows the ratio based on the current price and the earnings per share for last 12 months or latest 12 months. When you refer to regular screeners or BSE website, you are most likely to be looking at trailing 12 months price to earnings ratio. When you refer to this ratio, few things are to be kept in mind. A PE ratio by itself is of little value. It has to be seen in context of long-term averages or in context of the industry or other players' PE that the company competes with. This gives an idea about whether the stock is cheap or expensive as compared to its past valuations or as compared to its peers. Second, different businesses have different dynamics. For instance, it does not make sense to compare the PE of an auto company with that of an FMCG. So, while doing a peer or relative comparison, always use industry average PE or compare with the stocks from the same sector. For certain sectors such as banks, platform businesses that are still in the expansion phase and not making profits, cement, and cyclical sectors, the PE ratio does not give much insight into valuations, and other valuation metrics are preferred over PE. For instance, in case of banks, the common metric used for valuations is price to adjusted book value and not PE. Similarly, for cement sector, the metric used is replacement cost, that is how much it would cost to set up a similar cement capacity and is measured in enterprise value per ton. For cyclical businesses, PE by itself offers little insight. That's because earnings in cyclical stocks tend to fluctuate. If you look at a cyclical or commoditized business PE at the peak of the cycle, the PE might look lower due to higher earning base. Taking comfort from that could tempt you to enter at the peak of the cycle, which will not be good for your investment returns. P ratio is not a great standalone metric. That's because the earnings can be manipulated or may not reflect recurring earnings potential. This depends on how a company recognizes its revenues and expenditure. For instance, in case where sales happen without getting cash in time, or regular expenses such as R&D expenses are capitalized, or when policies related to non-cash expense such as depreciation are changed frequently, there is a good chance of earnings manipulation. That said, once a solid fundamental research on other aspects is done, PE is a great add-on and a very simple tool to get a sense of whether the stock is cheap, expensive, or fairly valued with respect to its peer in the same sector and its own historical averages. When it comes to PE, to value businesses, keep in mind that some businesses operate in multiple segments. For instance, ITC has exposure to both hotel and FMCG sectors. Well, even in case of Reliance, the businesses are ranging from refineries to telecom, and hence a single PE multiple for the earnings does not capture the dynamics of the different segments of the business. So, in such cases, one of the common ways of valuation is sum of the parts, where different segments are valued on different bases and the final values are added up. With these caveats, let's move on to some examples. This is a list of Sensex companies which are often valued on PE basis. As you can see, the range of PE for auto sector is very different from that of the FMCG companies. FMCG companies, barring ITC, which is not a pure FMCG play, are commanding higher PEs due to defensive nature of businesses in the time of slowdown. Similarly, auto sector being cyclical and working capital intensive in nature is assigned a relatively lower PE. Now, having come this far, let us now understand why companies in same sector, let's take the case of IT companies in the previous slide, are valued differently. Companies from the same segment are assigned different PEs based on multiple factors. In fact, this topic is so big that an entire book can be written on it. But to give you a basic sense, this could be a factor of management quality, their capital allocation skills, which implies how prudently they allocate capital. Have they made good investment in areas where growth opportunities are high? In case that's not the case, do they reward shareholders with the dividends or buybacks? Are they taking too much debt, compromising the quality of the balance sheet? What's the revenue quality? Are they too concentrated on one client or one business? Or are they getting cash for what they are selling? Or is it being stuck with the clients? Do they need too much of external cash for day to day operations or are able to manage operations from the cash which is generated in the business? Last but not the least, what are the future growth prospects? The list of factors that determine the PE goes on and on. Some of the basic ratios you could refer to assess business on these parameters include return on capital or return on equity, which measures the return per unit of capital invested or capital allocation skills. Cash flow from operations to net profit measures revenue or earnings quality. The higher, the better. If there is a huge gap, there is a possibility of earnings manipulation. Then look for consistency in profit margins because that would reflect the stability in the business and will give you a sense of visibility of the future. Improving profit margins indicate improving efficiencies and the stocks could deserve high multiple. Then we have debt to equity ratio that suggests the quality of the balance sheet. Then there's cash conversion cycle, the lower the better, and it reflects the liquidity in the company. Then we have profit margins and growth rate, and obviously, in both the cases, the higher the better. Now, if you remember, I talked about two kinds of PE. One that is calculated on the basis of historical earnings. Now, there is another aspect of PE called forward looking, where the earnings in the denominator are future earnings projections. You see, markets are forward looking. If a business is likely to make substantial improvements in growth, the markets would be willing to pay a premium for that growth in the earnings. For instance, let's say there are two companies A and B from the same sector that are similar on all the parameters that I talked about in the previous slide. On a 12 months earning basis, the stock A is trading at a PE of 24 while stock B is trading at a PE of 20. Does it mean that the stock A is more expensive and hence will offer less return? Well, what if I tell you that company A has actually added a few products and services that are likely to give a significant boost to its earnings, let's say a growth of 30%. On the other hand, the company B has a mature business and growth is unlikely. Here is how their forward P multiples will look. The forward PE multiple for stock A turns out to be 18.5 times versus 20 times for stock B. What this simple exercise suggests is that while PE ratio gives you a good sense of valuations, it cannot be accepted at face value to decide if a stock is cheap or expensive. A high quality stock with good growth earnings potential deserves a higher PE multiple as compared to a stagnant or average quality business in the same industry. The decision to buy a stock as such should not be solely determined by PE multiple, but the potential upside in the stock based on fundamentals and margins of safety in the valuation. That's all for today. Please share and like the video if you found it useful. Subscribe to our YouTube channel for such investing lessons. Last but not the least, do share your comments in the feedback section.